Mode.
Good afternoon, everyone, and welcome to the Credit Union Exchange Blueprint powered by EPL webinar. We'll get started in just a moment as we have people from around the country dialing in and joining us. My name is Bruce Clapp, and I'm your moderator for today. In just a moment, we'll get started. All right, good afternoon, everyone. My name is Bruce Clapp, and I'm happy to welcome you to the Credit Union Exchange Blueprint webinar today. And our subject for today is an update on the healthcare environment. And I'm sure many of you have questions, and you're fielding questions from your members as well. We're excited to share an update with you. And before we get started, I want to share a couple quick housekeeping items for you. Throughout today's session, which will last 60 minutes, you have the ability to ask a question on the right-hand side. If you post a question in your right-hand side toolbar, we'll be able to address those questions throughout the time today. If you have a chat question for another attendee or for one of the moderators, you don't want it to go in front of everyone, you can use the chat function. At the very end of our session today, we will have a question and answer and be able to address all the questions we've not gotten to throughout our time today. And today's session is being recorded and will be available on the CreditUnionExchangeBlueprint.com website as of late this afternoon. And you can share it with those that in your organization that perhaps weren't able to join us today. So with that, I'd like to introduce Robin Kolvik from EPL, who is going to introduce our speaker and be our moderator for today. Robin?
All right, great. Thanks, Bruce. Good afternoon, everyone. My name is Robin Kolvik. I'm the Senior Vice President of Business Development here at EPL. And joining us today is Eric Johnson, who's a recognized leader in the health insurance industry who provides education, guidance, and training support for Health Partners of America. And we really all appreciate you being here today to give you an update on the health reform changes now that our first open enrollment period comes to an end. As you all know, health insurance is going through unprecedented changes because of the Affordable Care Act. And there still seems to be much confusion. There's the government technical glitches. And let's face it, the open enrollment launch was not very pretty, but despite these challenges, many credit unions are doing their best to help members, their employer groups for members, navigate the complexities of healthcare. We have developed a series of webinars that you could gain access to on our CreditUnionExchangeBlueprint.com website of prior recorded sessions to help you gain a stronger understanding of the state of the insurance industry and the impact it's having on your members, employer groups, and the neighbors in every community you serve. We're sharing these series of webinars to keep you up to date on this ever-changing market. Today, our session is going to focus on what's transpired in the health insurance industry as a result of the Affordable Care Act, these changes that will continue to impact us in the market, the impact, Eric's going to share kind of the small and large employer group based on some of the implementations of the requirements of the Affordable Care Act. We have credit unions that are in the forefront of something new. Your members are navigating through some uncharted territories, and looking ahead in 2014 and beyond, your credit union can play a key role in helping your members gain access to export resources and provide access to insurance carriers based on the new health insurance requirements. As Bruce shared, our Credit Union Exchange Blueprint, you can be a trusted advisor to your members by offering a new type of solution that would be easy to implement and relevant to your members. Being located in Birmingham, EPL, we had a unique opportunity to partner with a leader in private exchanges in healthcare reform with Health Partners of America. They've helped serve brokers throughout the country, tools, resources, and training for their customers, and we worked with them exclusively to build the Credit Exchange Blueprint, which is a nationwide marketplace for health and related insurance built exclusively for credit unions and their members. So to talk more about the health reform changes and updates, we have the pleasure to introduce Eric Johnson. Eric's a recognized leader in the health insurance industry. Eric is a past president of Fort Worth Association of Health Underwriters and a regular contributor to the Benefit Selling magazine and other industry publications. He also is a two-time recipient of the National Association of Health Underwriters William Wetzel Award for Excellence in Public Speaking, and a National Instructor for NAHU's Consumer-Directed Healthcare Certification courses. Eric's a native of Texas, born and raised in Houston, and graduated from the University of Texas in Austin, and currently lives in the Dallas-Fort Worth area. So Eric, you can take it from here and go ahead and share what's happening in the healthcare environment.
All right. Well, thank you very much, Robin. I am excited to be here today. Health reform is changing, it seems like, on a weekly basis, so it is hard to keep track of everything. What we're going to do in today's presentation is spend a little bit of time talking about the three main market segments: the individual, the small group, and the large group market segment, and just kind of highlight some of the major decisions that have impacted them over the last few months and how that corresponds into an opportunity for credit unions that have a private exchange solution. Essentially, the private exchange solution is developed to help individuals sign up for coverage, and what we're seeing happen in the employer market is employers have a lot less incentive to offer coverage on a group basis, which of course pushes more and more individual members to that individual marketplace, and provides an opportunity to help them from the credit union standpoint. So with that, I think I have control of the screen here. Let me take a look here. Okay, so here are the main points that we're going to talk about today. I think Robin handled the objectives part. We're going to really take a quick look at where we are now that the open enrollment period is over. We'll talk about the individual market, the small group market, and the large group market, some of the delays in implementation of the major provisions of the law, and kind of finish with a what does this all mean section. And then, of course, we'll leave time for Q&A after Robin ties this back into the credit union opportunity and how you can take advantage of the trends that we're seeing in the marketplace. So the health insurance environment, it has changed a lot over the last few months, and it is a lot different from what we were anticipating. There have been obviously some supporters and a lot of critics of the health reform law from the inception, and a lot of people have tried to predict where we were going to go with this. Would it survive? Would we hit the enrollment numbers that they were hoping for? And you know, would it be repealed and things like that? Obviously, it has not been repealed yet. We did just finish the first 6-month open enrollment period, and as Bruce said at the very beginning, there were an awful lot of glitches early on. The healthcare.gov website enrolled a grand total of 6 people on day one, which matched the number that they joked about on Saturday Night Live when they did a spoof on the healthcare.gov site. They were actually right about the number of enrollments. So it didn't go well. Some of the state exchanges worked a little bit better. Some worked significantly worse. Some never got off the ground. There were millions of policies that were canceled in the individual market. Policyholders got cancellation notices from their insurance companies. And so there was, in general, a lot of early panic over what was happening. The administration did finally, I guess, get its act together and get the healthcare.gov site working, because the problems were so bad early on and people were having so much trouble actually accessing the site. They brought in the true experts. They looked outside of the government and brought in people that were able to get the site running and functional, and actually without too many glitches toward the end. That was actually necessary in order for private exchanges to work, because while a private exchange is a private market solution to these federal and state solutions, the private exchange still has to, on the back end, run through that healthcare.gov website in order to determine if people are eligible for a government subsidy. So if healthcare.gov doesn't work, then the private exchange sites don't work. So eventually they got it working after a lot of frustration, I think, on a lot of people's parts. The problem with the policies being canceled, that actually also sort of went away a bit as the administration announced an opportunity to renew these plans that were not compliant with the Affordable Care Act rules in 2014, and then they extended that to 2015 and 2016. We did just end the open enrollment period. It started on October the 1st, went through March 31st. It won't be that long again. It was a 6-month open enrollment window for people to first get signed up. So it was actually the initial enrollment period. It is going to start again on November 15th. That's changed a couple of times, but it'll start November 15th and run through February 15th. So that will be the next opportunity for most individuals to sign up for coverage, although in today's talk we're going to mention some people that might be able to access individual policies and the subsidies prior to that date. Employers right now are weighing their options for their next renewal period. A lot of large employers renew on January 1st, although not all do. Smaller employers tend to renew throughout the year, although there will be a lot of renewals coming up toward the end of 2014. And so employers are trying to figure out what they're going to do. If they make the decision to stop offering coverage, then that creates a special enrollment opportunity for any of those employees who are on the health plan who are now losing coverage. And so that's really going to be one of the driving forces behind the enrollments that will occur over the next 7 months until the open enrollment period starts again. So I think that this confusion among employers, this possibility that you're going to see employers dropping coverage and needing solutions for their employees creates a huge opportunity for solution providers, people or entities like credit unions with a private exchange website. A lot of companies and individuals are looking outside of traditional means, which is the insurance agent, to find solutions to the healthcare reform questions that they have. So a lot of opportunity exists even for companies that are not licensed insurance agencies. Private exchanges are more user-friendly than the federal and state exchange websites. They provide superior customer service. They offer additional products. Those additional products are important because that's what people can buy if they missed their opportunity to enroll during that initial enrollment period. We're going to see a demand increase for other types of coverage that can help protect people and their families. Non-public solutions are going to be more attractive than public options during the downtime. So during this downtime, during the time between the end of the open enrollment period and the start of the next open enrollment period, for all those individuals who are looking for coverage, for employers that are dissolving their group coverage and looking for solutions, they are much more likely to look to the private market than the public market. You're not going to see as much advertising from the administration for healthcare.gov and for the state exchange websites. So we could actually see traffic increase even though the open enrollment period is over with. So we're going to tackle each of the three market segments one at a time. And I want to start with the individual marketplace to kind of show what's going on there. In the individual market, oops, I went too far. In the individual market, it didn't look so good just a few months ago. We did one of these industry updates back in, I believe, December, and that was around the halfway point for open enrollment. This was one of the slides from that presentation. At that point, the health insurance marketplace was still 40% incomplete, according to one headline. Cybersecurity experts were recommending that the site be shut down. Doctors and hospitals were catching problems. A lot of the state exchange sites were having problems getting going at all. In Oregon, they were having to take paper applications. So things were not looking good at all, and there were a lot of predictions of the early demise of healthcare.gov and the state sites. However, what ended up happening is by April 1st, President Obama was able to announce that 7.1 million individuals had enrolled in exchange-based plans, and it turns out that was not an April Fool's joke. So we did get a lot of enrollments in these exchange-based plans. There were a lot of other individuals that signed up in what's called the outside market. In other words, they didn't technically go through the exchange. They purchased a product offered by insurance companies that were selling those exchange plans. That's important because those two pools of individuals are grouped together from a risk standpoint, from a rating standpoint. So it appears that the government hit the critical mass that they needed to make this thing work. The good news is, for anyone with a private exchange solution, both, well, that didn't, it's skewing a bit, but both of these options are available through private exchanges. The exchange-based plans that are going to be eligible for subsidies, as well as those plans that are sold outside of the exchange through a private exchange website, they can both be offered, and so individuals have more choices than they would through a public site. We also saw another 3 million people sign up for Medicaid or CHIP through the end of February. That number will no doubt grow when we get the March figures. So all in all, given the way that this thing started out, it ended up being, I think, probably a net win for the Obama administration and for supporters of the legislation. They hit the enrollment that they needed to claim success and maybe curb a little bit of the criticism that has plagued the last few months. So the other big problem, in addition to the healthcare.gov site that the administration was facing in the individual market, is these policy cancellations. What really happened here is when the law was signed, President Obama had said that if you like your health plan, you can keep it. That ended up sort of being true because there was a grandfathering provision in the law that said that anybody that had a health plan on March 23rd, 2010, who didn't change it, was allowed to keep it. The problem was that it wasn't actually an option for a lot of people, especially in the individual market, because insurance companies from time to time will change their plan designs. They cancel one group of plans and start another group of plans, and for those people that were moved out of those existing plans, they ended up in a non-grandfathered option, so they weren't allowed to keep their plan, and they started getting policy renewals, policy cancellations this past fall. There were other individuals who got those cancellations because they had purchased a plan sometime after March 23rd of 2010, so it could not be grandfathered. When people started getting all of these cancellations, the media started paying attention to it, and it became a huge news story. And so what ended up happening is President Obama announced a fix that would allow individuals to renew these non-compliant plans if the state and if the insurance companies permitted it. Some states did, some states didn't. Some insurance companies said yes, some said no, but it was up to them. But they were allowed to renew these plans if they wanted. Later on, the administration came back and later extended this option and said that not only can people renew these plans in 2014, they can renew in 2015 and in 2016. So some people got in under the wire and were able to get plans that they were back in 2013 that didn't comply with all of the new health insurance rules, but they're going to be able to hang on to those plans for a while. However, a lot of people that took advantage of that option may eventually find that they're going to do better by switching to a compliant plan. The reason is these non-compliant plans that they're allowed to renew, the ones that they originally got cancellation letters on that the president said no, you can hang on to for a while, those plans don't qualify for a subsidy. And since they don't qualify for a subsidy, people who have those plans are leaving a lot of money on the table if they make less than 400% of the federal poverty level. Where your income falls in relation to the federal poverty level is going to be based not just on your income amount, but on the number of family members you have. So basically, the more family members you have, the more you can make and still fall below 400% of the federal poverty level. So, for instance, if you have 5 family members, based on the 2013 numbers, you could make $110,000 a year and still qualify for a subsidy. The government did release just a few weeks ago the numbers for 2014, and they have gone up just a little bit. So now that 5-person family could make about $112,000 and still qualify for a subsidy. The reason that this is a big deal is because 63 to 68% of U.S. households fall below 400% of the federal poverty level. So from an income standpoint, they would qualify for a subsidy. And the subsidy amounts are significant. The way that the subsidies work is basically there's a benchmark plan. It's the second lowest priced silver level plan in the individual marketplace in a given area. And so that serves as the benchmark plan. The government caps what a family would pay for that plan at a certain percentage of their income, depending on where they are in relation to the federal poverty level. The government pays the rest. So if it's a younger individual with lower premiums, the government would be picking up a small share. If it's an older individual with much higher premiums, the government might pick up a much bigger share, even though they're at the same income level. So what this chart that you're looking at shows is the dollar amount per month that families would pay if they purchased that silver level plan. If they purchased a bronze level plan, their premium would be even lower than what you're seeing here on the screen. But just to kind of show you a couple numbers, let's say you have a 4-person household and they make $40,000 a year. That means that they could cover their entire family for $160 a month. That's significantly less than what they would pay for family coverage on a group plan. If it's a 5-person household that makes $40,000 a year, then they could cover the whole family for $120 a month. So where with group health plans, employer-based health plans, as you add additional family members, you tend to pay more. If you add a spouse to the plan, you pay more. Add your kids to the plan, you pay more. With the individual marketplace, with these subsidies, bigger families that make the same level of income as smaller families actually pay less. So it is difficult for employers to compete with the government on this. It's difficult for employers to offer enough contribution where it's going to be advantageous for those employees to be on the group plan rather than the individual plan, because most employer-sponsored plans don't cover family members. So what happens now? Well, open enrollment is over. The individual marketplace, that open enrollment period, that initial enrollment period has ended. We're in a 2-week kind of grace period right now where people who tried to sign up for coverage and had problems, technical problems, they can still get signed up potentially, but shortly that'll be over. And then those who didn't purchase coverage during that initial enrollment period, they're basically out of luck until November 15th. That's when the next open enrollment period starts for a January 1st effective date. So the fact that these people can't sign up for qualified coverage that would help them avoid paying a penalty, and the fact that they can't go apply for a subsidy now, that doesn't necessarily eliminate their need for health insurance. In other words, the fact that somebody missed the boat and didn't get in time, that doesn't mean they don't need protection for their families. Public exchanges have absolutely no options for these folks. Private exchanges do, and that's because through a private exchange, these individuals could actually purchase a short-term medical plan, which is not guaranteed to issue. They would certainly have to qualify from a medical standpoint, but there aren't that many medical questions, and these plans tend to be lower in price than a major medical policy. So you can actually get pretty good coverage with a short-term plan purchased through a private exchange that will protect your family. While it won't help you satisfy the individual mandate, it does offer an option to get you some coverage in case something unexpected happens. In addition to that, there are supplemental products, accident plans and critical illness plans and things like that that are offered through the private exchange that also gives people a way to protect their family in the event of something unexpected.
Hey,
So,
Eric, before you move on, I got a quick question from
absolutely.
Bob that I thought would be appropriate. Um, uh, he asked the question that even if there is not a qualifying event, i.e., job change, marriage, etc., individuals can still purchase health insurance through the private exchange, like the Credit Union Exchange Blueprint.
You cannot buy a qualified plan right now outside of this open enrollment period. The basically the guaranteed issue window, the reason that the government created these open enrollment periods is because the main purpose of this law was to say anybody that wants health insurance can buy health insurance, right? So all plans are guaranteed issue now. Well, that's kind of a losing proposition for insurance companies because obviously anybody that has a serious medical condition is likely to sign up. People who are healthy might say, well, I'll just wait until something happens and then I'll sign up. And so the whole purpose of this open enrollment window is to make people make a decision and sign up when they are permitted to, and that way they're paying into the system maybe before they need coverage. So you can't go buy a qualified major medical policy that's going to satisfy the individual mandate if you don't have some sort of special event that gives you that opportunity. But there are still insurance products out there that, yes, can be purchased through the private exchange side, such as these supplemental products or short-term medical plans. And at the very least, what that does, even though you may have to pay a small penalty for your family for the year, the penalty is almost negligible for some families, depending on their income. Even though you may have to pay a small penalty, you're getting covered. You're getting some sort of protection so that if something happens, you don't go bankrupt. And that is available through the private exchange side.
Very good, thank you.
All righty. So the other thing, and that question also alluded to it, which is, what if something happens, some sort of special event? Is there an opportunity to sign up for coverage outside of the open enrollment period? And there is. There are situations. Marriage is a good example. Marriage, adoption, birth of a child, where you could add dependents to your plan outside of the open enrollment period. And obviously the change of that family structure could have an impact on the subsidies that your family might be eligible for. So you might qualify for a bigger subsidy now that you have a bigger family and the same income. So those sorts of things can definitely happen outside of open enrollment, and people can use the credit union private exchange site for that. In addition to that, though, I think where a big opportunity is going to exist is involuntary loss of group coverage. That creates a special enrollment period for individuals and for their families. So to kind of understand that, we have to look at what's happening on the group side, what's happening with small employers and what's happening with large employers. On the small group side, the small group marketplace, generally that's going to be companies with 2 to 50 employees, and there is no requirement that these companies offer health insurance. If they choose not to, there is no penalty. So there's a measure called full-time equivalence where the government requires these employers to add together not just their full-time employees, but actually add their part-time employees that count as fractions of employees. So a 15-hour employee, for instance, counts as half of an employee when determining how many full-time equivalents you have. But any company with fewer than 50, they're not required to offer coverage. There's no penalty if they don't offer coverage. Now, the government wanted these companies to keep offering coverage. At least the non-conspiracy theorists believe that the government wanted these companies to keep offering coverage. So they put in a couple of incentives in the law. One of the incentives was a small employer tax credit that companies that have up to 25 employees could qualify for, where the government helps pay part of their insurance bill, essentially. And then there's a small group exchange site that the government is creating. It's called the SHOP Exchange, the Small Employer Health Options Program. And it was designed, or it was envisioned as an option for these small employers to allow them to give their employees more choices of health plans. In other words, the employees would be able to choose not just among, health plans A, B, and C, but they could actually choose between health insurance companies. One could go with one insurance company, one could go with another. Most small employers don't seem all that interested in that option from my experience. So I don't think you're going to see a ton of small employers just flocking to this shop exchange. In addition to that, though, the government is saying that any company after this year that wants to claim that small group tax credit, they have to enroll through the shop exchange. Well, a couple of problems happen for the government in this. One is that small employer tax credit, it has not been very popular. Originally, the IRS sent out postcards to 4 million small employers that they thought might qualify for the tax credit. They later redid the math and said, well, we still think 3.2 million might qualify for at least a partial credit. By mid-2012, which was 2.5 years after the tax credit was first available, only 175,000 employers nationwide were claiming it. So while those employers will have to sign up through the shop exchange when it's up and running, there's just not a whole lot that are claiming the tax credit, so you're not going to see that initial base in that program. And then on top of that, they had some problems with the technology, obviously with healthcare.gov, and so they postponed the shop exchange a full year. It's not set to go into effect until this November, and in all of the speaking that I've done, I've just, in talking to both insurance agents and employers and other groups that have contacts with employers, there just does not seem to be much interest in this shop exchange program. Instead, companies that are most likely to qualify for the tax credit are also the ones that are most likely to drop their group coverage because they have low-paid employees who would likely qualify for better subsidies in the individual marketplace. So only a small fraction of employers are claiming the tax credit, and so I really don't see them hanging on to coverage because of the government's efforts, because of the tax credit or the shop exchange. On top of that, small employers are kind of reevaluating their health plans because a lot of them are reaching the conclusion that the benefits that they offered in the past are not as beneficial anymore for their employees. Here's why. Starting this year, all plans are guaranteed issue. In the past, people who had medical conditions, they needed an employer-based plan to get coverage. That's no longer the case. And so the Congressional Budget Office actually issued a prediction a few weeks ago that over the next few years, you're going to see 2 million people leave the workforce as a result of the Affordable Care Act, but it's not because the employer is laying people off, but rather because they no longer need health coverage through the employer to get their conditions covered. They have that same option in the individual marketplace, and so you're going to see a lot of people purchasing individual health plans because of that. A second reason that the benefits of the group plan aren't as beneficial anymore is because all plans now cover the same benefits. All plans in the individual market cover the same thing that would have been covered in the group market. Benefits like maternity and mental illness coverage, those are now covered in the individual market, so it's not a unique benefit of employer-sponsored plans. The biggest reason that you're going to see some employers reevaluating what they're doing is because having a group health plan blocks most employees and their family members from those generous government subsidies. In other words, the numbers that we saw, where if you make less than 400% of the federal poverty level, you can qualify for subsidies that pay a significant share of your premiums. If you have coverage available to you through an employer, you're not eligible for those government subsidies in most cases. And so a lot of small employers are looking at that and saying, well, gosh, I don't want to hurt my employees. I mean, number one, you generally offer benefits to attract and retain workers, and now offering benefits could repel them because an employee might say, well, if I work here, I don't get to insure my family, and they may seek out employers that don't offer coverage. But I think on top of that, you have more possibility in the small group market that you're going to see employers make decisions based on moral obligation. There was a survey about a year ago that asked small employers, why do you offer health insurance? And the number one reason was not to attract and retain quality employees. It was because they feel morally obligated. So these employers that say that they feel morally obligated to offer insurance, those are the ones that are probably more likely to operate by the first do no harm principle if they have employees coming to them and saying, because you're offering coverage, I can't get health insurance for my family. They can't afford the dependent premium on the group plan, and they don't qualify for those subsidies in the individual market because the employer is offering health insurance. Now, one thing that we're going to see in the small group market is that December 1st will be a really big date for a lot of these small employers to make a decision to drop coverage. And the reason for that is because the health reform law changes a lot of the rules in the small group market. It makes the plans more comprehensive. They have to cover certain benefits that weren't covered before. They have to, they're going to have cost sharing limitations on some of those benefits. In addition to that, there's something called modified adjusted community rating rules, which what those basically mean is that insurance companies can no longer charge more based on medical conditions or based on gender. And so a lot of the things that differentiated the premiums that companies would pay in the small group market, they're not going to be allowed going forward. And so while some companies will win because of that, a company with a lot of young females or a lot of sicker individuals, they could actually pay lower premiums. A lot of other small companies, those that were paying below average premiums in the past, they're going to lose. They're going to pay more to help offset the cost of some of these sicker companies whose premiums are coming down. And so what ended up happening is in 2013, a lot of these small employers trying to put off the impact of these new rating rules as long as possible, they renewed early. They renewed their plan December 1st, 2013, so the change, this impact, doesn't hit them until December 1st of 2014. That's when they're going to get these renewal increases, and in a lot of cases, companies will see their premiums go up 50 to 100%, and at that point, they may just not be able to offer coverage anymore. So up to this point, a lot of small employers, they just haven't had to deal with it. As they start coming up for renewals in the next few months, you're going to see a lot of them just decide I can no longer offer coverage, or they will decide that they need to drop their coverage so that their employees can access the subsidies. And any of these employers that renew during the year, maybe a July or an August renewal date, if they drop their coverage during the year, that creates an open enrollment window where their employees can go buy an individual plan through a private exchange and access a subsidy along with it. And that kind of brings us to the large group marketplace. Bruce, I don't know if you have any questions about small group at this point, but I'd be happy to pause and answer them, or we can dive into large group.
Do have one question, excuse me, from Ann. And Ann's question is, if the employer did renew in December, did they typically renew for a full 12 months?
Actually, the way that it works with group health insurance is those companies that renewed in December, they have their rates guaranteed for 12 months. So the insurance company can't come back in June or July and raise their rates, but they're not locked in. So they don't sign a contract. And those companies, they can make the decision at any point. So you could have a December 1st renewal date, but you could make the decision in May that you don't want to offer coverage anymore. And if you stop offering as an employer, that creates a special enrollment opportunity for the employees. Okay.
Very good.
All right.
Thank
Well, the last big segment is the large group marketplace, and it is a lot different than small group. Large employers, they don't have those same rating restrictions that we're seeing in the small group market, and so their premiums aren't going haywire like we're seeing in small groups. So most large companies, if they want to keep offering coverage, they can keep offering coverage, but a lot of large employers don't want to offer coverage. Nonetheless, there is a employer mandate that is set to go into effect in 2015, and we could literally talk all day about the mandate. I'll try to make it short and sweet. Um, the mandate is described, it's created by the Affordable Care Act, and the portion of the tax code that's created by this is Section 4980H. And under Section 4980H, that's the employer shared responsibility requirement, there are two possible penalties an employer might pay. The first penalty is the Cap A penalty, and it is going to apply that to employers that don't offer health insurance to their employees if they have 50 or more employees. So a company that has 50 or more is required to offer coverage. If they don't, they're going to pay a $2,000 penalty on each of their full-time employees, with the first 30 excluded. So in other words, if you had 100 full-time employees, you would take away 30. That would leave 70. 70 times 2,000 would be $140,000 in penalties, and it's not tax deductible. So they kind of added insult to injury there. If an employer does offer coverage, then they avoid that across-the-board penalty, but instead they're going to pay a $3,000 penalty per employee who actually goes and gets a subsidy. Now, in this case, if the employer is offering coverage, the only way an employee can get the subsidy is if that employer plan isn't good enough, it doesn't at least meet that bronze level requirement. So some employers are looking at these skinny plan options that we've read about in the Wall Street Journal. If they offer that, they avoid the across-the-board penalty, but the employees could still go get a subsidy, and the employer would pay a penalty on them. For most large employers that offer insurance, the only employees that can get a subsidy are those that spend almost 10% of their household income on just the employee portion of the premium. So whatever the employee-only share is after the employer has contributed their cost, if that amount exceeds 9.5% of the family income, then the plan would be considered unaffordable and they could go get a subsidy. In most cases, that's not going to happen. The employer plan blocks them from getting a subsidy. But employers are trying to figure out, what to do with this, and they've been busy strategizing for the last few years. The mandate was actually scheduled to go into effect on January the 1st of this year, but back in July of 2013, these large employers sort of got a stay of execution. They were told at that point that the mandate was being delayed 1 year, so it wasn't going to go into effect until 2015, and then the associated reporting requirements, the 6056 form that they have to fill out and send to the IRS, that's also been delayed a year. A lot of these employers, obviously they breathed a sigh of relief because of the delay, but the other delay they haven't been as excited about, and that is the final rules. And we've been waiting and waiting and waiting for the IRS to give us the final rules on the employer mandate and how it's going to work. And while the proposed rules were issued back at the beginning of January last year, we didn't get the final rules until about a month ago. February the 12th is when we got those final rules. It answered some questions for employers, which was good. It also provided some transitional relief for 2015. And that transitional relief is going to make it less likely that large employers will offer coverage going forward, or at least in 2015. Here is what the transitional relief said. There's really two different types of relief. The first one is that companies that do offer coverage in order to avoid the across-the-board penalty, now they only have to offer coverage to 70% of their full-time workers instead of the 95% which was previously required. So for 1 year, they kind of have some wiggle room there on which employees they offer coverage to. But the second one is the bigger one. This is for companies that have 100 or more employees that are required to offer coverage but don't. instead of excluding the first 30 employees from the count when they're determining what their penalty is, they get to exclude the first 80 employees. So to kind of give you an example of this, let's say that a company has 80 employees who average 30 hours a week or more. Each of those counts as one full-time employee. Let's say they have another 40 employees, and each of those employees works half-time. They work 15 hours a week. Well, you add up those fractions of employees, and you come up with another 20 full-time equivalents. And when you add the 80 and the 20 together, you're at 100. So this is a 100-employee company in the IRS's eyes. So what that means is they have to offer coverage to their full-time workers. If they don't offer coverage to their full-time workers, though, there's actually no negative repercussions because you don't count the part-time employees when you're determining the penalty. You only count the part-timers to determine if you're subject to this law or not. So in this case, even though they have 100 full-time equivalents and they're required to offer coverage, what this company would get to do is they would take their 80 full-time employees, those are the ones they're supposed to offer coverage to. If they don't offer coverage, they get to exclude the first 80 rather than the first 30. That leaves you with 0. So for 2015, there would be no penalty for this company. 2016, that's when the normal rules go into effect, and this same company, if they don't offer health insurance, they're going to pay a penalty of $100,000. You would subtract the first 30 full-time workers, that leaves you with 50. 50 times 2,000 is $100,000 in penalties. So for 2015, the government has given these big employers a $100,000 break on the penalty. And so for those companies that have been trying to figure out what to do, I think it just makes the math a whole lot easier for them. And so, Bruce, if you'll give me about another minute, I will sum it all up, and then I think we can turn it over to Robin and then answer some questions. But kind of to put it all together here, the open enrollment period, it's done. It's done until November the 15th. We got 7 million people enrolled during the first one. That was better than anybody really expected. I think over time, because we got so many people to sign up in the individual marketplace, people are going to start figuring out how big these subsidies are. In other words, you're going to see a lot of interest in the subsidies, not because the government's pushing them, but because people are going to talk to friends and family members who were able to get the government to pay a big portion of their premium, and suddenly they're going to be interested for this next year. So you're going to see some strong enrollment, I believe, starting this fall. Employees with employer-sponsored coverage, they're blocked along with their family members from the subsidies, and because they're going to be a lot more interested in these subsidies when they hear about them from friends and families, you're going to start hearing or start seeing a lot of pressure on employers to drop their coverage. I think you're going to see a lot more employees going to employers and saying, you're hurting me and my family by offering health insurance. Small employers want to do the right thing. They're not required to offer coverage. They're facing big premium increases. So a lot of the small employers, they're not going to have to be asked more than once to drop their coverage. Larger employers, the penalty is often less than the premium. For these companies that were doing the player pay calculations, for a lot of them, it already made sense to drop coverage, let the employees access the subsidies, and then pay the associated penalty. The transitional relief for 2014, which says they didn't have to offer coverage this year, and the relief that we see in 2015, where they get to exclude the first 80 employees from the count, it makes it a no-brainer for a lot of these companies. The numbers work out significantly better for those that don't offer health insurance, depending on the size of the company, and because of that, I think you will see some of these big employers, as they start to come up for renewal, if they have mid-year renewal dates, they may actually make the decision to discontinue. So this creates a big opportunity for credit unions. Opportunity is knocking, so when opportunity knocks, you need to answer. With that, I'm gonna go ahead and give it back to Bruce and Robin, and then we'll answer some questions in just a little bit.
Eric, thank you for the opportunity to hear the update. There's lots going on in the marketplace, and I'll turn it over to Robin now, and she'll talk specifically about some of the impacts we're seeing as it relates to some of the membership, the employer groups, and the credit unions that the Credit Union Exchange Blueprint is dealing with. Robin?
Right. Thanks, Bruce. And as Eric shared with you, obviously health insurance is going through really sweeping changes, and with the national health insurance requirements, I mean, there's been great learning curves and lessons learned throughout the last year. But based on the philosophy of people helping people, our vision is that your credit union can play a key role in helping your members and potential members and employer groups navigate the complexities of healthcare. So as Eric shared, there's an opportunity for your credit union. So for years, credit unions have been playing, a key role in their community. We've had a survey most recently found as far as you being viewed as one of the most trusted organizations when it comes to protecting and building wealth. And Bruce, if you want to move over to the next slide, that'd be great. And from that standpoint, as Eric shared, the government, has created the Affordable Care Act. And we talk about willing to pay, the premium support for the low to middle income Americans, where about 60 to 68% of the people are going to qualify. And people are going to know that more today than they did last year. So these tax credits are a changer for both employers and the employees. And it's really going to change the way employees view their group health plans and be a factor in how they're going to make decisions to offer or drop coverage. So as your members, your credit union, or employers or consumers, the bridge that can be made by your credit union can be between the third-party administrators, carriers, insurance consultants. Through the Credit Union Exchange Blueprint powered by EPL can help those members meet those needs. And as a matter of fact, 79% of the employees view their employers as a trustworthy source to help them grow and protect money, only second to their credit unions. So a couple of things that we'd like to ask you is, what, from a standpoint of your members, and how many of your members are being impacted, and your employer groups or members are being impacted with the health reform changes. What are they doing about it? Eric talked a lot about the impact of small and large groups. So what are they going to do about it in 2014? And then would your credit union benefit by providing the expert resource to answer these questions? The Affordable Care Act is changing really how we provide insurance, and will certainly change how people are going to acquire coverage to protect their families. And more than 180 million people are going to continue to face the needs of changing their access to insurance. And with 95 million members being served and counting, the credit union is uniquely positioned as that community hub and local businesses for your local businesses and employees and members. So really just a quick just share a little bit about what the Credit Union Exchange Blueprint is, just to give you a quick overview. There's 4 components of the product. You have the Credit Union Exchange, which is actually your own online portal. It is privately labeled. You build your exchange that fits the specific needs of your members and your employer groups. We have an administration area that gives you access to all types of marketing tools, training materials, education, anything you need to do to support your program, along with access to what we call the CRM, which gives you all the ability and insight to real-time access into what your members are purchasing, what information are they asking for, so purely clear line in sight, backed by a fulfillment center that's staffed with licensed insurance agents that can help them answer and address and provide the expert advice for your members. So ultimately, the Credit Union Exchange Blueprint has a couple different options to choose from. There's 4 different templates. I'm not going to share any of those with you, but you can see that it will be completely customized and branded to your organization. And what makes this unique, really from a Credit Union Exchange Blueprint, it's a true end-to-end solution. From really sharing all the way from sales to servicing to complete site customization to site branding to how you provide the leads, what products and services you want to offer both on the group and individual side. So again, it's completely built and unique to your credit union. So ultimately feel that this is a great opportunity for credit unions to continue to be that trusted advisor for your members and really to offer a new solution that ultimately is going to help increase membership, offer a new emerging product in the business area, obviously strengthening the relationships in your community, and be that community hub, because the health insurance is changing for so many people, and it's only going to continue to evolve. We're only in the beginning of the impact of the Affordable Care Act. So with that, I know we shared a lot of information with all of you as it relates to Affordable Care Act, and just a quick introduction to the Credit Exchange Blueprint. We really appreciate the opportunity of sharing this information with you, and we do encourage you, to reach out to visit our Credit Exchange Blueprint site, learn more about how you can expand the services for your members, and being a resource for your credit union members and employer groups. When I turn it over to Bruce, I know we're coming up here on time, just to address any questions that the group may have for Eric or myself, or for Bruce.
Very good, Robin. Thank you, and Eric, thank you. We have about two or 3 minutes left, but plenty of time to answer a couple questions. Just as a reminder, on the right-hand side of your toolbar, there's a question feature. You feel free to tap a question in. We do have a couple that are out there. Robin, the first one I'll address to you, and it's kind of a general but specific question about the Credit Exchange Blueprint. What has been the response of the credit union system in offering this program?
Good. I think from a credit union perspective, credit unions feel that what we've heard is that their members are facing unprecedented changes as it relates to the health insurance environment with the changes in rules, and they're looking for a trusted resource for options and guidance. And the credit unions have felt by implementing a partnership like the Credit Exchange Blueprint would help give them, their members or employer groups, the resources, the expertise, and the access that they need to provide the right find the right coverage to protect their family and what ultimately matters most to them.
All right, very good. We have 2 other questions, and again, feel free to type in any additional questions in our last remaining moment or 2 here. But Robin, generally, what kind of feedback are you hearing about the Credit Union Exchange Blueprint from the credit unions that are involved at this point?
Good. The credit unions that love the easy access to the Credit Exchange Blueprint portal and the ability to truly brand exclusively for their credit union, the flexibility of selecting the type of insurance coverage to augment the health insurance has been a really big plus for them, because member of credit unions have other insurance relationships. So again, the portal that is built is neutral. So it additionally gives the access to our call center experts for ease and professional interaction has been extremely valuable. And really, finally, Bruce and the team, the credit unions have really appreciated the marketing support and guidance that accompanies the program.
All right, very good. Looks like we have 1 remaining question, and this might just fit nicely with our time that's allotted. But did you hear any complaints about technical bugs through the Credit Exchange Blueprint? Eric talked a lot about exchange problems with the federal exchange.
Yeah, we didn't hear many stories of issues with those that have tried to access. We did hear, I should say, access the federal and state exchanges, as Eric did share. We virtually had no complaints to the credit unions and their members. We think everybody ultimately understood that this was more of a government problem, not necessarily a credit union problem. And the Credit Exchange Blueprint is really the private exchange that Eric talked about, the differences of the private and public exchange, which is operated by insurance professionals built for the credit unions and their members, and gives them a wide variety of health plans and options to help them protect their families. Also, it gives them the ability for members who qualify for subsidies and providing them really a consumer-friendly experience.
All right, Robin, thank you very much. And Eric Johnson, thank you very much. We've reached the end of our time allotted today, and thank you very much for everyone that's attended from around the country as we've listened to the updates about the health exchange marketplace and all of the changes that have occurred since the implementation of the Healthcare Act. Please feel free to visit the CreditUnionExchangeBlueprint.com website for not only a recording of this session, and you can refer coworkers to it, but also previous session recordings that we've had. Also look forward to additional webinars that we have scheduled throughout this year. You can find that schedule also on CreditUnionExchangeBlueprint.com. And Robin or Eric, any last comments before we head off and wish everyone adieu?
Just thank you from my end. I hope that this was beneficial. I know it's a lot of information, but hopefully you can see the general trend. Employers are trying to figure out what to do, and that's kind of putting their employees in a bind in some cases. And I agree with Robin. There's a huge opportunity there if you're able to provide that solution. So thank you very much. Appreciate being part of it.
Yes, and thank you very much for your participation, and we look forward to hearing from you and sharing more on how you can help your members and employer groups be that resource to navigate the unprecedented changes that we're experiencing here in healthcare. Thank you, Eric, for your time in sharing your information with our group, and thank you, Bruce.
Very good. All right, thank you, everyone, and this will draw our session to a close for today. Have a great rest of the week. Thank you.